So building on aggregate supply and demand, one thing that we now need to do is, okay, how do we boost aggregate supply, or how do we boost aggregate demand? How do we boost the economy? And the answer is what we call fiscal policy. And what fiscal policy is it is using the tools that governments can use. So we're talking about Congress and the president in the United States using government tools to try to boost the economy. So it's what we refer to as using taxes and government spending. Okay, so raising and lowering taxes, or raising or lowering government spending, the amount of money spent by government on different things, to try to alter aggregate demand or aggregate supply and influence the economy. And there's two different viewpoints on how to do this. One of them is what we refer to as Keynesian or demand side fiscal policy, and that is trying to boost aggregate demand by moving the aggregate demand curve. Okay, so what Keynesian fiscal policy is trying to do is it is trying to move the aggregate demand curve to the right. Okay, supply side fiscal policy tries to do the opposite. What it is trying to do is it is trying to move the aggregate supply curve to the right. Okay, it's trying to increase supply and influence the economy by doing those things. Keynesians generally then try to influence the economy by boosting government spending, by getting money directly in the hands of consumers. And while this provides short-term boosts, it often does not cause a lot of long-term growth, actually causes a lot of long-term problems. And we saw this in the 1970s as kind of the natural end result of 40 years or so of Keynesian policies, is that we eventually ran into stagflation, because in the long run, the deficits that are piled up and the imbalances that happen in the economy due to Keynesian policies, constantly trying to stimulate demand, do a couple of things. They cause inflation, but they also misplace and misallocate resources. Supply side fiscal policy generally is trying to do the opposite. What they're trying to do is reduce costs for businesses. And by reducing costs for businesses, that increases the aggregate supply curve. It increases each individual business's supply curve, and thus the aggregate supply, by allowing them, by having fewer costs, to produce more goods at a lower cost. So supply side fiscal policies would be things like cutting taxes, cutting government regulations, cutting things that increase costs for businesses. Supply side is intended to do is promote long-term growth rather than short-term growth. So I'm going to focus first on the Keynesian model here, and there's a lot here, and I'm going to kind of back out for a moment, and I'm going to kind of simplify this, okay? And then we'll come back to the notes. So basically what we have here are we have businesses, okay? And we have households or consumers. Okay, remember, people in households are both consumers and workers, right? We got businesses, and we got households. And then we've got government that's a third party, okay? So this is the Keynesian model. Now, of these two, remember, businesses provide the supply and households provide the demand in the market generally, okay? And obviously, in the factor market, it's the opposite. But in the consumer market, businesses provide the supply of goods and households provide the demand, okay? And so what Keynes believed is that when there is an imbalance in the economy, what has happened is households are not spending as much, okay? He believed this was the most stable part of the economy, was the consumer sector, or C in CIGX, right? Consumption. And so if consumption is down, that means households aren't spending as much money. And so what needs to happen then is somebody needs to get money in the hands of households so that they'll spend it. So we have government getting money to households, okay? And the way they can do it is through a few things. They can do it through government spending. They can do it through lowering taxes. And usually that's what we call that a targeted tax cut, a targeted decrease in taxes, or they can do it through what we refer to as deficit spending, okay, which is borrowing money, essentially spending tomorrow's money today. You're borrowing money from tomorrow's taxpayers so that you can spend it now to give a short-term boost to the economy now. And so that's one of the things that Keynes said, is that there should be no, there should be no constraint. If you've got to go into a deficit, go into a deficit here. But if you have to borrow money, borrow money. But the idea is the government needs to prime the pump of the economy because the economy's not running. And so he believed, there's not enough exchange of goods and services happening. And so we need to get money in the hands of households so they'll do it. Because when they do so, they will spend it, right? And then that will benefit business. And then what will happen then, where does government get its money? Through taxes, right? So government then will pay this back by primarily taxing businesses, so that those businesses then, they have benefited essentially from the government spending because they make excess profits or additional profits from the government spending on getting money in the hands of households so they can buy the product of businesses. And so government will then get its money back by taxing those additional profits that businesses make, and thus have the money and the cycle repeats. So government kind of acts as a broker between businesses and households for consumers. And that is the demand side, or the Keynesian model. It's called Keynesian because it's named for John Maynard Keynes, who developed it. In 1936 was when he published his work, The General Theory of Employment. But the Keynesian model really was in vogue even before that, and most notably with FDR. So the basic idea behind the Keynesian model is that it focuses on increasing aggregate demand. Okay, what we're trying to do is get money in the hands of households, and thus doing so through boosting government spending. Usually, there's also sometimes some targeted middle or working class tax cuts as well. The idea then is to push the aggregate demand curve to the right. Okay, and so again, he encourages deficit spending, and the idea is that it'll boost the economy because we are in a recession because C is down, consumption is down. So instead, we need G, government spending, to increase. Government then will pay for the excess spending through increased taxes. And so now, how much will an increase in spending assist the economy? Well, Keynes came up with the spending multiplier. Economists have kind of used the spending multiplier, which is how much will a change in government spending change aggregate demand? Okay, so we can use the spending multiplier to figure that out. Keynes believed in what we call the marginal propensity to consume, that out of every dollar people have, how much of that are they going to save and how much of that are they going to spend? Okay, and so if the marginal propensity to consume, and this is a decimal here, is 60%. People are going to spend 60% of a dollar. Okay, the spending multiplier then is 1 over 1 minus the marginal propensity to consume. So if people say we'll spend half of every dollar, we'll use half, okay? That means the marginal propensity to consume is 0.5, right? 50% of every dollar gets spent. So 1 over 1 minus 0.5 is 1 over 0.5, which is 2, which basically means that every dollar of government spending will increase real GDP by $2. Okay, what if people spend 3/4 of their new dollars, okay? What if people spend 75 cents on every new dollar of government spending, okay? Well, now the marginal propensity to consume 75 or 0.75. So now the spending multiplier is 4, right? 1 over 1 minus 0.75 is 0.25. 1 over minus 0.2 or 1 over 0.25 is 4. So every dollar of new government spending would lead to $4 of growth of real GDP. Now, critics of Keynesianism and critics of this model will say, yes, you will see an increase in real GDP, but that will be offset by inflation because the aggregate supply curve will slope upward. And as we increase aggregate demand, you'll see, yes, real GDP will go up, right? But the inflation rate, the price level will also go up, okay? And so, yeah, you'll see an increase in economic activity, but that will be offset by inflation and increase in prices because you have more competition over scarce resources, okay? So understand the spending multiplier. You'll work a little bit more with that later on. So the basic idea behind the Keynesian model is that to grow the economy, one can either increase government spending or reduce taxes on households. And again, the problems with this are twofold. Number one, inflation in the short term. And number two, deficits. And again, inflation is actually a monetary phenomenon, but there is a part of the Keynesian theory as well that deals with increasing the money supply to facilitate the increase in government spending. And we're going to look at the money supply more next week. Now, if inflation is a problem, you can contract the economy then by decreasing government spending or increasing taxes. And usually that would only be done. We would only ever want to try to reduce aggregate demand through increasing taxes or decreasing government spending to curb inflation. The key idea behind Keynesianism is you are trying to boost this aggregate demand curve and move it to the right. You're trying to boost demand. And you boost demand by getting money in the hands of households, of people. Okay, not businesses, but people, because then they will spend that money. Now, again, the problem is that two things. Okay, obviously the increased money base that will lead to inflation. The other major problem that you run into is there is an increased, is that you have to increase taxes in the future to pay for today's spending. So you'll have less economic growth in the future. And the other thing is that no central planner can have enough knowledge to know how goods and services should be allocated. And so as a result, the increased taxes and the increased government spending may cause imbalances in the economy because it will take money away from more efficient, productive uses and direct them to less efficient and less productive uses. Okay, we've seen good examples of the Keynesian philosophy this summer when the government passed a stimulus package. What did they do? They gave every adult in America a $1,200 check. You got $500 for every child. We're a family of 4. We got $3,400 just deposited into our account. What was the idea behind that? People would spend that money and therefore kind of get the economy going again and boost and benefit businesses. That was a Keynesian response to the recession that was caused by the pandemic shutdowns. Another Keynesian response was boosting unemployment benefits to $600 a week. Same thing, get money in the hands of consumers. Now, the problem is both of those have to be paid for with future taxes. And so that will stunt economic growth in the future with the idea of getting a short-term jolt now. Okay. The opposite of Keynesian is the supply side model. Okay. And I'm going to go back off of the presentation here for the moment so that we can kind of go back to our whiteboard here. And again, we've got business and we got households, okay? Now, in the supply side model, businesses create the supply, right? Households create the demand in the consumer market. So what we're trying to do is we're trying to lower costs for businesses. And in doing so, we'll push the supply curve to the right, okay? We'll push the supply curve to the right, which means economic growth without inflation, okay? We got economic growth, okay? But the price level actually goes down. So you have economic growth without inflation. That's the basic idea here. And so the basic idea is we are trying to lower costs for businesses. So what can government do to lower costs for businesses? Simple. They can cut taxes and the regulations that government requires for businesses. Okay. So what that does, they can also loan money to businesses, things like that. But primarily what we're trying to do is we're trying to cut costs for businesses, usually by reducing their taxes. And what happens then is that businesses have additional money, right? Now, when businesses have money, they spend it on hiring more workers, giving workers raises, buying capital equipment like building a building or buying new machinery. And again, those things don't make themselves. So those workers benefit. Businesses expand, they can produce more goods at a lower price. And as a result, households benefit because those households are also workers. Okay? Remember, they're workers in the factor market. They're consumers in the producer market. Okay, those households are around workers. Those workers then have more money because more people have jobs. And so they're going to take that extra money and they're going to spend it on the product of business. And then businesses now have more money. When they have more money, they will spend it on more capital equipment, hiring more workers, giving people raises, expanding their businesses. That benefits households who work at said businesses, and thus those households are also consumers. And so the cycle repeats, and we see long-term economic growth. Now, the key thing with the supply side model is that you see an increase in supply. And so this is somewhat derisively called trickle-down economics by its critics, because the idea is, oh, we cut taxes on businesses and the profits will trickle down to consumers. And then we look and we see, oh, well, Bill Gates made a gazillion dollars last year and his workers only made a few thousand each. Therefore, trickle down doesn't work. Well, yes, Bill Gates did better, but his workers also did better. The basic idea behind the supply side is the idea that the rising tide lifts all the boats in the ocean. That when you reduce costs, everybody benefits. There's economic growth, more things get produced, prices go down in real terms, and more people have jobs. And therefore, you're not reliant on government to boost the economy. You're reliant on the free exchange of businesses and consumers. And so, again, the model isn't necessarily going to be, oh, Bill Gates and his workers, Microsoft workers are going to all benefit equally, but they are going to benefit. That's the idea behind the model. But the real idea behind the model isn't necessarily the idea that, well, the profits are going to quote unquote trickle down from businesses to workers. But instead, the idea is that you're going to have long-term economic growth that benefits everybody. Some will benefit more than others, but you can't really have equality and prosperity at the same time. You're going to have economic growth because of the reduced costs for business means more people have jobs, while also the things that are produced, the things that are sold on the store shelves become cheaper. Okay. And notice here, as the aggregate supply curve moves to the right, we move down the aggregate demand curve. We have an increase in real GDP, but there's a decrease in the price level. Okay. And so again, the supply side model is based on the idea of reducing taxes, reducing regulations, and also reducing government spending. The government doesn't need to spend as much money on welfare programs or on stimulus checks and things like that. Number one, because in theory, the economy is growing at a steady pace. And number two, because more people have jobs. So as a result, businesses, the idea behind this, businesses can produce more goods without increasing prices. Now, supply-siders often cite what's referred to as the Laffer curve, which is there is a relationship between tax rates and tax revenues. And the Laffer curve is kind of a horseshoe, or an upside-down horseshoe, because at a 100% tax, the government will collect $0. At a 0% tax, the government will collect $0. But there is a point in between at which the government will maximize its tax revenue. And if the tax rate is too high, what will happen is that cutting taxes, let's say tax rates here, cutting taxes will actually increase the amount of revenue to the government. Okay. Now, that doesn't mean every tax cut will increase the amount of revenue, but if your taxes are too high, they're discouraging saving, investment, and economic growth, and therefore they're stifling and slowing down the economy and actually harming the amount of taxes that the government receives, because an economy is dynamic. And so there is a point at which cutting taxes actually will not only benefit the economy, but through the benefit to the economy will also benefit government, because it will lead to an increase in taxes. Okay. And so, in addition to kind of going back to the Keynesian ideas here, in addition to increasing government spending, boosting aggregate demand, cutting taxes not only increases aggregate supply on the business side, it also increases aggregate demand, okay? Because it increases people's disposable personal income. And so if you cut taxes, you will also increase the GDP. And the tax multiplier is 1 minus the spending multiplier. And again, remember the spending multiplier is 1 over 1 minus MPC. So, and so a lot of times this will be a negative number because the increase in taxes, or an increase in taxes, will obviously reduce GDP, but we lower taxes, okay, then we will raise GDP. So when we cut taxes, it will increase aggregate demand. So the change in taxes times the tax multiplier would be a change in aggregate demand. So if we lower taxes by, say, 10%, we lower taxes by $100 million, multiply that times the tax multiplier that's -3, and boom, that's going to be $200 million worth of increase in aggregate demand. Okay, so the one thing to note, taxes and government spending, but especially taxes, tend to be an automatic stabilizer to the economy. And so what that means is that taxes can kind of just in their very nature increase or decrease GDP. They can slow down a expansion, or they can curb a recession just by their very nature. Taxes and government spending will both do that. So for example, even if we don't change the tax rate, tax rate stays, say, 20% on average, well, during expansions, there's more economic activity, so the government collects more in taxes. That will slow down the economy and limit inflation, and also should lead to a budget surplus. And so all the debts that we incurred, in theory, during the recession can get paid down. That usually doesn't happen. But, theory is, that's kind of how it works in theory. Then during recessions, tax collections are lower. The government doesn't collect as much in taxes. So therefore, people are able to keep more of their own money, and therefore they're able to spend more, which will boost economic activity and limit the impact of the recession. So basically, what I want you to get out of today, number one, is understand the supply side in the Keynesian model. Okay, understand that in the Keynesian model, we're trying to boost demand, so the government is getting money in the hands of consumers. In the supply side model, we're trying to boost supply, so the government, through reducing taxes or reducing regulations, is trying to reduce costs for business so they can hire more workers, spend more money, and thus get money in the hands of consumers. the way that works is understand both the tax multiplier and the spending multiplier, the math behind those. And kind of the ideas here, are we trying to boost aggregate supply or are we trying to boost aggregate demand? And what are the kind of the consequences to that? If we boost aggregate demand, as we learned yesterday, we will have inflation, but we'll also have an increase in real GDP. If we boost aggregate supply by reducing costs for businesses, we should boost real GDP, but we should not also have inflation. On the flip side, if you reduce aggregate supply by moving that supply curve to the left, the opposite happens. That's where you have inflationary recessions like we did in the 1970s, where costs for businesses are going up. We have inflation, but we're also in a recession. So that's the main takeaway I want you to get out of today. So tomorrow, what we're going to do is begin looking at the role of government in this, in taxes and government spending.